everyone. I'm Brandon Garrett with BentOak Capital, President and Chief Investment Officer of our firm. We're a comprehensive wealth management firm headquartered in Weatherford, Texas. We have offices in Fort Worth and Lubbock. And today I am excited to share with you a few concepts that I think are really timely in this economic and market environment. And also, what should you do or not do as things unfold, and how can you stick to a plan for the long term? So I'm going to pull up a couple of slides quickly. And I will add that at the end, please stay tuned for a disclosure statement for compliance purposes. And here we go. So the first thing I want to talk about is really just putting volatility into historical perspective. People say that history doesn't repeat itself, but often we find that it rhymes. You've probably heard that quote before. And so how do we look at volatility as investment advisors, and what can history tell us as we make decisions in today's environment? So one thing I want to show you is these are annualized returns of the S&P 500 is the blue bar, and the orange down beneath is the intra-year pullback. So during the year, even in these big positive years, the S&P was down at some point. And what does that look like? Well, on average, over the course of the last 30 plus years, you've seen a drawdown of about 14% a year. So this volatility recently here in the spring of 2022, you may think this isn't ordinary. It actually is very ordinary to see this type of volatility. And probably, if nothing else, if you were to say what's not ordinary, it's the 2021s and the 2019s and 2017s, where you see very little pullback, very little volatility with a strong up market. So actually what we're seeing now, guys like us, we don't really lose, and gals, we don't really lose a lot of sleep over this kind of thing. This is pretty normal market activity. Now, I know there's some issues happening right now around the globe from a geopolitical standpoint that definitely makes these moves more pronounced as we kind of watch events unfold. But again, this is nothing out of the ordinary. So just to show you, well, how often does a pullback happen? 5% pullback. How often does that happen? 3 times a year. So on average, you would expect the market to have a 5% pullback at least 3 times a year, almost every quarter. So again, what we've seen from a historical standpoint, not that out of line. What about a 10% correction? We see exactly one of those a year. We go all the way back to what we call kind of the modern markets, the post-World War II era. So back to 1950, we see on average 10% correction a year. So again, we went many years throughout the last decade. You can see to the far right of this chart where there's some missing blue bars. That means we actually didn't have any of those. So what we think we're seeing is not just an increase in volatility, it's kind of a return to the average, or what we typically would see. So again, nothing we've seen here over the last few months from a statistical standpoint is very telling from a historical perspective, very normal. And so a question we get a lot is, well, golly, the market's down. I'm going to wait until things are better to invest. So if you think about investing 101, that's all about buying low and selling high. So right now, actually, if you look from a statistical standpoint, a mathematical view, does it make sense to invest? Would it make sense to put money into the market? Well, can't see the future, but again, we can see if history can rhyme. And if we go all the way back to 1982 and look at every 10% plus pullback that we saw over this 30 plus years, you'll see, anywhere from 10 to 15% correction, which is basically where the S&P has been. That's where the Dow's been. The NASDAQ's actually a little bit worse off than that, 20% plus. If you look out 1 year or 2 years, and I know y'all get tired of hearing guys like us say, focus on the long term, but there's a reason we say that. And it's not because we just need you to stick in there so we can help pay for our kids' college education. It's because it makes sense from a prudent investment standpoint to stay invested for the long term. And so this data will show you after a 10 to 15% correction, on average, you saw a 21% positive move to the upside 12 months later. So if you can look at the math down there at the bottom, 92% of the time, the market is higher, an average of almost 22% after a 10 to 15% correction. So again, now's the time when things are down, you start kind of feeling gloomy and you hear the people coming on the news and think, I need to get out of the market. The data shows that actually that's wrong. Now is a better time to buy than it would be to sell, or at the very least not sell. So when we look at charts and what really matters over the long term, we look at what do stocks do over the long term. And you might think, well, what's happening in Russia, Ukraine has a big effect on that. Interest rates, inflation. Of course, those things move the markets over the short term. But what about the long term? So I want to show you two different charts. It's actually two different data points, but they're actually very similar. So this kind of feels like going to the optometrist where we say better here or better here, better here or better here. That's actually not the same chart. It just looks really similar. So this is the Dow Jones over the last 100+ years. You can see, yes, there's volatility, but long term, that orange bar, the trajectory of the market has been up. That other chart that I showed was the S&P 500 earnings. So a lot of the time we look at the short-term noise and things that influence markets over the short term, but over the long term, it's all about profitability and our stock earnings strong. And so we continue to see that and see that stock earnings this year have been solid. And there's no reason for us to believe that stocks will not do well over the long term, because again, what drives stocks is not just short-term market movements. What drives it is long-term profitability of companies. And so I'll show it to you one more time. Basically the same chart. So that's everything you need to know about stock investing right there. Is just, are earnings positive and growing? And yes, they are. So what should you do right now? Or more importantly, what should you not do right now in this kind of volatility? So the market, you see this kind of movement like we've seen in the first quarter of 2022, because just like human beings, the market doesn't like uncertainty. The market prefers stability. And so whenever there's uncertainty around commodity prices and geopolitical risks and interest rates and inflation, you will see volatility. And things will typically clear up whenever economic prospects are a little bit more clear. And that's what we've seen over the last couple of weeks, as things have been determined that there are some silver linings. The market's really got a reprieve. So what to do when confronted by a bear? And so all of my Fort Worth area folks hopefully will appreciate this slide. That's the Angelo's barbecue bear. If you've ever been to Angelo's to have some brisket and maybe some cold beer, you have definitely rubbed elbows with this guy. So what do you do when you're confronted by a bear? Survival experts will tell you, really, there's only a few things you need to do. You shouldn't run. You shouldn't flee. You should move very slowly, possibly lay on the ground and play dead. So I'm not telling you when you open your brokerage statement to lay on the ground and play dead. But what I am saying is there's something to be works. And so oftentimes you may be familiar with the concept of thinking fast and thinking slow. I know, Josh, we've talked about that book before. And something that the brain does is whenever, say there's something flying at your head, you need your fast brain so you can react quickly. If you're driving a vehicle and you need to get out of the way, you need your fast brain to move quickly. But what do you need your slow brain for? Well, that's more strategic decisions. That's more calculated decisions. So most of the time, if you're in an emergency, 99.9% of the time, you want to count on your fast brain to get out of there. But actually, when it comes to a bear encounter, you want to do the opposite. You got to slow down and use your slow brain. So the same thing can be said for a bear market. When you're seeing volatility, everything within your body is saying, I need to hit the panic button. I need to get out of here. I need to do something. But in actuality, what you really need to do is probably slow down, think a little bit more strategic about the long term and how those decisions could affect you. And that's the better path forward versus running away. So what are some things that running away could do? Well, could definitely affect investors. If you were to stay fully invested over the last 20 years, you would have seen an annualized, and excuse me, this is as of 2020, 2019, an annualized return of close to 8% on the S&P 500. If you missed just one day, the best day of the year, you would have returned 3.9% a year over that time period. If you missed the two best days, 0.8%. The best three, you can see the math gets worse. So if you missed the best 20 days of the year, you would have lost 27% a year. So I know what you're thinking, but maybe you might think, well, that's only if I missed the best days. What if I could also just get out of the market and miss the worst days too? Well, that usually tends to happen close to the same time period. So anytime we look at markets and we see this volatility, usually the biggest losses are followed by the biggest gains. So you can see this is in 2008, towards the end of 2008, whenever volatility had really spiked and peaked. Huge loss, historical loss day, 9% on the S&P, followed by almost an 11% gain just within a few days. So again, when you see this kind of volatility, it's easy to say, man, I need to get out because things are not looking good. But more than likely, if historical data can be any guide, you could potentially see quick moves to the upside, which we have seen the last few days, the last couple of weeks. So I'll leave you with just a couple more thoughts as we talk about what not to do. This is actually a study done by Dalbar. I've followed this study for about 15 years of retail investor outcomes versus the S&P 500 index. And if you look at the S&P going back over the last 30 years, you're looking at close to 10% return. If you look at the average equity investor, so someone that's calling the shots, buying and selling their positions, they return 5%. So that's basically, you've cut your return in half by letting volatility dictate your plan and trying to make market moves and time the market. So that's always a slide that jumps out at me. It's data, it's evidence-based, it's the truth. And that is that trying to time the market in a time like this can be very dangerous. So you might be asking, well, what should I do? And so the first thing you should do is definitely have a financial plan. Investing without a financial plan and a reason behind your investments will almost always lead to misguided decisions at some point, because you don't have anything to go back to, any kind of doctrine or philosophy of what's driving my decisions. Why am I investing? What am I investing for? So I would encourage you to work with a financial planner and build a financial plan, a roadmap to determine what your financial objectives are and what you need to be doing to accomplish those objectives. And then I would encourage you to build your investment strategy around that, not vice versa. So rather than letting your investments dictate your life, let your life dictate your investment. So I'll leave you with that. And I'm glad that I was able to share with you today. There's a lot of information, but hopefully if you have any questions, we'll be able to connect with you. Be glad to hear from you. BentOak Capital, Weatherford, Texas.